Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week at Everything You Need to Know in 90 seconds at 9 o'clock, and it's all about emotions today by markets, central bankers and fiscal policymakers. Yesterday's surprise Fed cut seems to have been an own goal, spooking investors rather than reassuring them. If they'd had to cut by 50 basis points, it must be bad, seemed to be the reaction. Equity markets fell with the S&P 500 down 2.9%. But today, the same market is up 2.8% in midday trade, and it's a rally that seems to be all about domestic US politics and the rise of Joe Biden. Emotion and sentiment is driving Wall Street rather than economic data. And data from the world's airlines isn't positive. January passenger travel growth was down to 2.5% year on year, down sharply from 3.8% in December. And air cargo volumes are now falling year on year, down 3.4% year on year. The industry expects both sets of numbers to be much worse when February and March data is released. A UN agency said that China's exports of parts and components for products ranging from cars to cell phones shrank by $50 billion in February, costing other countries and their industries lost output. The shipping data is wildly negative too. And employment levels in the US will also be the focus this week, with the February non-farm payrolls report to be released at the end of the week. Today we got the precursor ADP report showing for February it dropped back to 183,000. Manufacturing jobs actually shrank, and almost half the rise was for either healthcare workers or fast food workers. And the widely watched ISM services PMI was very positive, showing a good expansion. But the alternative and internationally benchmarked market services PMI gave an opposite view, showing the fastest contraction in the US since October 2013. Following the US Fed, Hong Kong was the next to cut rates, dropping them by 50 basis points to 1.50%, and then Canada cut its benchmark policy rate by 50 basis points to 1.25%. They have inflation at their target and economic growth close to potential, but they cut because of what they expect the COVID-19 impacts will be. China's slowdown is less about how their factories have been affected than how their giant service economy has been retrenched. More evidence came today with the private sector Caixin Services PMI, which dived to a fierce contraction. However, in the huge Pearl River Delta industrial zone, over 90% of workers are said to have returned to work, and that involves more than 6 million people. But there are major doubts about how much work is actually being done, and more than half of all SMEs haven't reopened. In Australia, their economy grew faster in the fourth quarter of 2019 than most analysts were expecting. It grew at 2.2%, and well above the 2% rate expected, and above the third quarter rate of 1.8%. Of course, all this was before the bushfires and the coronavirus. It won't be repeated for a long time. And there are now widespread expectations that major fiscal stimulus is about to be unleashed in Australia to avoid it falling into recession. The US Treasury 10-year yield is now under 0.97%, a new record low and down 4 basis points overnight. Gold is on hold today at this higher level, down $3 to $1,642 an ounce. And US oil prices are little changed, now just under $47.50 a barrel, and the Brent benchmark is at $51.50 a barrel. And the Kiwi dollar starts today weaker at 62.8 US cents. On the cross rates were softer too at 95.1 Australian cents, but against the euro were unchanged at 56.4 euro cents. That means our trade-weighted index is a little lower at 68.1. I'm David Chaston. That was 90 at 9 by interest.co.nz.